So let's get right into a real puzzle that's going on in the markets. We've got soaring inflation. We've got global conflict. I mean, gold should be flying high, right? But it's not. In fact, it's crashing. So what is really going on here? Let's break it down. If you're watching the news, you're probably hearing that the gold rally is over, that it's dead in the water. But you got to ask yourself, in a world this unstable, does that really add up? Why would the ultimate safe haven asset suddenly take a nosedive? That's the question we're digging into today. And this slide, well, it lays out the problem perfectly. On the one hand, you have all the reasons gold should be doing great. And on the other, you have what the market is actually doing. It's this total disconnect that's at the heart of our story. So here's our game plan for getting to the bottom of this. We're going to start with what the mainstream is saying, then we'll peel back the curtain on Wall Street's mechanical selling. We'll look at the paper price versus what's happening with physical demand, explore these two totally separate gold markets, and then wrap it all up with some long-term perspective. Okay, first up, the official story. This is what you're probably going to hear on financial news channels about why gold's suddenly on the outs. The argument you'll hear everywhere goes something like this. Inflation is being really stubborn, which means the Fed has to keep interest rates higher for longer. And when interest rates are high, US dollar gets stronger. A strong dollar makes an asset like gold, which doesn't pay you any interest, look a lot less attractive. That's the official narrative, anyway. But what if that's not the whole story? According to our source, this isn't about the big economic picture at all. Nope. This is about the market's internal plumbing, a really violent mechanical reset that's happening completely behind the scenes. And here's the theory, and it's a pretty cynical one. The claim is that this isn't some random market move. It's a strategic liquidity flush, and it's supposedly designed to absolutely crush the smaller retail investors who jumped in late, often using a ton of borrowed money. Now, to really get what's happening, you need to know about a specific kind of player on Wall Street: systematic hedge funds. Look, these aren't rooms full of people making gut calls. These are powerful computer algorithms just running code. They automatically buy and sell based on preset rules. They don't care about inflation or geopolitics. They just follow the model. So, how did this whole spiral kick off? It was like a chain reaction. First, a spike in oil prices gave bond yields a little push upwards. That was the trigger. The second those yields moved, the algorithms at these big hedge funds just sold automatically. They flooded the market with tens of thousands of paper gold contracts, which slammed the price down. And that price drop, it triggered margin calls for all those smaller, leveraged investors, forcing them to sell too. It's a pretty brutal, self-fulfilling prophecy. But here's where it gets really, really interesting. While all this chaos is erupting in the paper market, the world of contracts and derivatives, the market for actual